120 minus your age. 120 minus your age, is that a good rule of thumb to determine how much of your portfolio should be in stocks? I'll tell you the good, the bad, and the conclusion. That and more coming up. My name's Mike Bernardo, the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. How much of your portfolio should be in stocks, right? We know stocks have a high future potential rate of return, but we also know the roller coaster, the ups and downs can make you seasick and at times make you want to jump off. So what's the appropriate amount of your portfolio to have in stocks? And should that change as you go throughout your career? We all know you should probably hold less stocks at the end of your career than at the beginning, but what's the right amount? Well, for a few decades, a rule of thumb has meant to sort of spur investors on, or at least give some sort of clue as to what that answer should be. And that rule of thumb was originally 100 minus your age. It's sort of been updated to be 120 minus your age. That's the investment rule of thumb for how much of your portfolio should be in stocks. For me, I'm almost 45. Let's say 45. So 120 minus 45, I should have that percentage, that much of my portfolio in stocks. So then the question is that the percentage that I have in stocks? No, I have 100% in stocks. And not that that is appropriate for everyone, and certainly not that that's appropriate for everyone that's 45. Yet for me, I look at that as time horizon. Well, I don't plan on retiring for a long time. I don't plan on touching dollars for a long time. And therefore, the dollars should be allocated more aggressively and have a higher percentage of stocks. But that's me. That's me. So what's the good? Why has this investment allocation rule of thumb or investment strategy rule of thumb been around for so long, and why do still some people use it? Well, it's unemotional. It's simple, it's straightforward, and it's unemotional. That is something that I like about it. This unemotional approach to how much of your investments should be allocated to stocks versus bonds, that can help you avoid one of the largest investment mistakes people make, and that is, for lack of a better term, the hokey pokey. I'm jumping in, I'm jumping out. Right? Which is that's what our emotions lead us to do, especially during extreme times like we saw during COVID or during the great financial crisis, or even during 2022, the last real bout of volatility that we saw. Well, I guess the tariff tantrums earlier this year, that certainly had people on edge. But in 2022, it felt like for 10 straight months, the stock market did nothing but grind lower. Down and down and down. That's a long time period to keep your emotions in check. And so this rule of thumb, 120 minus your age, is simple, it's straightforward, and it's unemotional. I also like that it sort of auto-adjusts based on how old you are. And therefore, this suggests that when you're younger, you should have more in stocks. When you're older, as you get closer to using these dollars, or maybe in retirement, you should have less money in stocks. I think as a principle, we would all agree. But where does this rule of thumb fall short, right? It certainly does. It has its drawbacks. And the first one is not all investors are the same. We are not the same. Even if we're the same age, we are not the same. We might have different risk tolerances, preferences, or perspectives when it comes to risk. We have different financial circumstances. We maybe have different goals of when we'd want to retire. We might have a different financial situation. You might have a pension. I might not. You might be receiving an inheritance at some point. I might not, right? We are different, both in emotions, like I already talked about, and how we view risk and how we feel with those ups and downs and gyrations of the market. But the rest of our financial situation, it's just different. That's why your investment allocation always needs to be a part of all 6 areas of your financial life and needs to be decided in the context of all 6 areas of your financial life. But this rule of thumb falls short in that it doesn't account for the differences and the uniquenesses about each of our financial circumstances. It also falls short, I'm going to say, early in your career, right? If you are just getting started investing at age 30, 120 minus 30 means you should have 90% of your portfolio in stocks. Unless you're super risk averse, you're not at age 30, you're not going to touch those retirement dollars for 30 years, maybe longer. Right? And so that is a long time horizon by anyone's book. I do not think it would be appropriate for the typical 30-year-old to have 10% of their portfolio in bonds or in cash. I think early on in your career, this doesn't line up. And then lastly, the last point that I'd make, and that this rule of thumb really isn't something to follow in practice. It might be a good general guide, but not something I would implement verbatim for your situation, is it doesn't align with a withdrawal strategy, a distribution strategy. Instead of a 120 minus your age, instead of that rule, I would base the percentage of your portfolio that should be in stocks based on your comprehensive financial plan, looking at all 6 areas of your financial life and determining what are those uniquenesses, what are those differences in your specific financial situation. And then I would determine that asset allocation, certainly looking at your risk tolerance, but also your time horizon. When are you going to need the money? Because a better approach than this 120 minus your age is a what we call personal pension plan. Others call a buckets of money approach, aligning how much of your portfolio should be in less risky or less volatile investments based on when are you going to need the money. Again, going back to that 30-year-old example, if you're not going to need the money for 3 decades, it should all be in long-term instruments. And long-term instruments is the stock market, okay? But if you're going to retire in 3 years, some of your money is short-term. Not all of it. Some of your money is short-term, and that the money that is short-term should be in short-term instruments. The money that's intermediate term should be in intermediate term instruments, and the money that's still long-term, even if you're going to retire in the next couple of years, should still be invested for the long term. This personal pension plan, this is how pensions allocate their resources, where they're both investing for the folks that are not going to be retiring for a few decades, but they're also having that liquidity for the folks that are already retired and collecting that pension. Others call this the buckets of money approach. And so where you're looking at retirement, the money that you're going to need in the next 2 to 3 years should be in low risk investments, should be very stable, earning a little bit of interest and very predictable. That money should not have really be subject to market volatility. And it's just really a calculation of, well, how much money do you think you're going to need in the next 2 to 3 years? That much money should be in low risk. The amount of money that you'll need for 5 to 8 years after that should be in intermediate term risk. So whether that's a bond ladder, whether that is a balanced portfolio, maybe that's some hedging, something like that, where you've got some upside potential, but you've got limited downside. You're more protected on that downside. But then the money that you're not going to need for 10 plus years, that money really should be for the long term and really should be invested more aggressively. At retirement, that doesn't mean that long-term bucket should be 100% in stocks, but it should be more so in stocks than the other 2 buckets because it's long-term in nature. So does the 120 minus your age rule of thumb for investment allocation, does it hold water? No. It is no substitute for the comprehensive work that you need to do working with your certified financial planner, looking at your present financial position, your protection plan, your tax planning, your investment strategy, your retirement goals, your estate plan, looking at all of that together. That's going to help you determine how much of your portfolio should be in stocks, what are the right investment strategies, what's the right risk tolerance, and should you implement a buckets of money or personal pension plan approach, and if so, when? Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.